Tax mistakes that cut your profits. Taxes can quietly eat away at your investments, turning what seems like a winning strategy into a less exciting outcome when the tax bill arrives. As an investor, it's vital to understand how taxes interact with your portfolio and the steps you can take to minimize their impact. In this video, we'll explore common tax mistakes that cut into your profits, share strategies to avoid them, and provide actionable solutions to keep your returns intact. Whether you're a seasoned investor or just starting out, this is an essential guide to mastering tax efficiency in your investment journey. Taxes are often overlooked until it's too late. Many investors focus solely on the rate of return or picking the best performing assets, but taxes can significantly reduce your bottom line if not addressed properly. For example, frequent traders often fail to factor in the impact of short-term capital gains taxes, which are taxed at higher rates than long-term gains. Similarly, investors might overlook opportunities to optimize their accounts or make minor errors in timing asset sales, leading to substantial penalties. Every dollar saved on taxes is an extra dollar reinvested, compounding wealth over time. Proactive tax management isn't just a minor detail, it's a critical component of successful investing. Without careful planning, taxes can quickly erode gains, leaving you with significantly less than you expected. So what are these mistakes and how can you avoid them? Many investors fail to take advantage of tax loss harvesting, a powerful strategy of selling underperforming assets to offset taxable gains. By neglecting this, investors often pay more in taxes than necessary. Even if the market dips, strategically managing your losses can save money at tax time. Retirement accounts like IRAs and 401ks are excellent vehicles for tax-advantaged growth, but failing to use them effectively can leave money on the table. For example, some investors don't maximize contributions to these accounts, while others withdraw funds prematurely, triggering unnecessary taxes or penalties. Short-term capital gains, assets held for less than a year, are taxed at a higher rate than long-term capital gains. Investors sometimes sell assets prematurely to lock in profits, not realizing the hefty tax implication of these quick moves. Investors operating across multiple jurisdictions might overlook the varying tax laws in different states or countries. This mistake can lead to double taxation or missed opportunities to claim credits on applicable taxes. Certain investment-related expenses like advisory fees or interest on loans used for investments may qualify for tax deductions. Failing to investigate or record these can result in lost savings. To reduce your tax liability, practice tax loss harvesting strategically. For instance, if a stock in your portfolio has declined significantly, selling it to realize a loss can offset the gains from other profitable investments. Remember, this can also apply to mutual funds, ETFs, and other vehicles. Contribute the maximum allowed to tax-deferred accounts like IRAs and 401ks. For 2023, the contribution limit for a 401k is $22,500, or $30,000 if you're over 50. Additionally, consider a Roth IRA for its tax-free withdrawals in retirement. Whenever possible, aim to hold investments for more than a year to benefit from the reduced tax rate on long-term capital gains. This approach is particularly effective for high-growth assets. Tax codes are complex and mistakes can be expensive. Engaging a qualified tax advisor can save you from costly errors and uncover opportunities you might have missed. Don't wait until tax season. Starting discussions early allows for tailored advice suited to your portfolio. Consider tax-efficient investment vehicles like index funds or ETFs. These funds often incur fewer transactions and therefore generate fewer taxable events compared to actively managed funds. To support your efforts in managing taxes, leverage technology and professional services. Tax optimization software can help calculate potential savings, track your investments, and generate reports to ensure compliance. Additionally, portfolio management platforms often integrate tax-efficient strategies such as rebalancing. Rebalancing your portfolio to maintain an ideal asset allocation is a smart move, but doing so carelessly can trigger unnecessary tax liabilities. Opt for tax-efficient rebalancing, which considers factors like losses to offset gains when making adjustments. Another overlooked tool is meticulous record keeping. Maintaining clear documentation of transactions, dividends, expenses, and past losses ensures that you can file accurate tax returns and avoid audits or penalties down the line. Consider an investor who purchased a stock at $10,000, only to watch it decline to $7,000. Instead of holding on, the investor sells to realize a $3,000 loss. This offsets a $3,000 gain made from another stock, resulting in zero taxable capital gains and thousands saved in taxes. A frequent trader, despite booking $20,000 in gains, faces $8,000 of taxes on short-term profits due to their higher tax bracket. If the trader instead held those positions for the long term, the tax bill could have been reduced drastically, preserving more of the profit. An early career investor prioritizes maxing out Roth IRA contributions every year. By retirement, the tax-free growth on contributions snowballs into a substantial sum, showcasing the efficiency of tax-advantaged accounts. For investors with more complex portfolios, advanced tax strategies can further enhance returns. If giving back is part of your financial goals, consider donor-advised funds. These allow you to donate appreciated assets, avoid capital gains taxes, and receive an immediate tax deduction. Investing in municipal bonds offers the advantage of tax-exempt interest at the federal level, and sometimes at the state level too, if issued within the investor's state. For those in higher tax brackets, this option provides steady, tax-efficient income. If you hold international investments, understand how foreign tax credits work. These credits help offset taxes paid to other countries, preventing double taxation and preserving global investment profits. Navigating the tax landscape can be overwhelming without professional guidance. Accountants and financial advisors specialize in strategies for minimizing your tax liabilities. They stay updated on the latest tax regulations, making your financial strategy proactive rather than reactive. Periodic consultations with a professional ensure your investment plan evolves as law changes or your financial goals shift. Taxes are a moving target. What worked last year might not be optimal this year. By building a relationship with a trusted advisor, you can anticipate adjustments and maintain momentum in your financial growth. Investing effectively isn't just about choosing the right assets. It's also about ensuring your profits are protected from avoidable tax mistakes. By avoiding errors like ignoring strategies such as tax loss harvesting, mismanaging retirement accounts, or neglecting long-term gains advantages, you can retain more of your hard-earned returns. With the addition of solutions like professional advice and tax-efficient tools, your portfolio becomes optimized for sustainable success. Take action today. Review your investment strategies, consult professionals, and implement tax-smart practices. The sooner you start managing your tax liabilities proactively, the more room your investments have to grow. Prioritize tax efficiency and reap the rewards of careful, informed decision-making.